to be clear. I'm a senior advisor to Kraken. We have a fantastic panel here today. Why don't you go through and introduce yourselves and give us one sentence on how people should remember you and what you're working on today. Go ahead, start.
Michelson. I'm Director of Global Sales at GK8. GK8 is an infrastructure provider for custody, fully owned by Galaxy. We provide a full stack solution, impenetrable vault, MPC, highest insurance in the market, $1 billion US of insurance, and a lot of more interesting stuff.
Thanks very much. I'm Simone Maini. I'm the CEO of Elliptic, and we build blockchain analytics solutions for institutions. So we're really focused on serving both the traditional finance space as well as payments, crypto natives, and governments. So it's actually our 12th birthday this week, which in the crypto space, obviously a pretty long time. So, really proud of being part of the industry for that period of time.
Great. My name is Carmi. I work at Figure Markets. I run the exchange, the ATS, and the broker-dealer. We aspire to be the exchange for everything. The last thing we rolled out a couple of weeks ago is a stablecoin product regulated by the SEC that pays interest back to its holders, called yields. You should all buy it.
I'm Amar Kuchinad, CEO of Copper. We're a collateral manager for participants in the derivatives market, OTC and exchange. We also provide custody, staking services, and an agency lending business on our foundation.
All right. Well, it's a fantastic panel, and I want to kick it off by congratulating North Korea on just impressive work over the last over the last cycle. Maybe you don't have to applaud for that, but I'm sure they'd appreciate it. Maybe we can start off by just explaining what the heck happened in Bybit.
You want me to start?
Yeah.
Sure. So yeah, this panel is about risk mitigation, and it would be odd not to talk about Bybit, so great place to start. I'm sure everyone here is well aware that Bybit was hacked by the North Korean cyber group, the Lazarus Group, for $1.4 billion about 3-4 weeks ago. And while a lot of the kind of interest and heat has kind of come out of it now that the initial hack is over, the laundering process is still very much underway. So there's still a lot to talk about and a lot to watch as a blockchain analytics company, and for all of our customers as well, to make sure that they are not exposing themselves to inadvertently laundering these funds. Last year, the North Koreans hacked a total of about $1 billion, and in total over all the years that we've been tracking this, it's a total of $4 billion. So you can put the 1.4 in the context of those other numbers. It's a very, very significant hack, and Elliptic is calling this the biggest digital heist ever in any kind of market.
So what happened? How'd they do it?
So the hack was not actually of Bybit itself. It was from some custody software that they were using, and that was perpetrated through social engineering. Our kind of belief is that this is something that they had been able to get access to for quite a long time, and they'd essentially been sitting waiting for the right moment like a honeypot, and they saw their chance. I had a lot of people commenting that, it was Friday night, it was after Consensus Hong Kong, it was really frustrating. I was like, not frustrating, that was deliberate. Like, they knew exactly what they were doing. People were tired, people were on planes, people were distracted. The North Koreans are world-class at this. So they perpetrated the hack that they had set up over a long period of time, exactly when they wanted to, and ultimately a transaction was signed that shouldn't have been signed for the movement of $1.4 billion. So they took control of those funds. But taking control of them doesn't necessarily mean that they can actually do something useful with them. And so with such a large amount of value, again, this is the largest amount of crypto or value of any kind that has been hacked. The laundering process was going to have to be complicated and lengthy if they are going to successfully be able to ultimately cash out. So that laundering process is still ongoing. we're not talking about it as much, it's not in the media as much, but it's ongoing. They are going through, 5, 6, 7 stages of laundering right now, and before we get to a conclusion.
Okay, so you find yourself with $1.4 billion on chain, mostly ETH, right? Mostly ETH. What do you do with it if you've stolen it?
Yeah, you're going to use every obfuscation technique that you can find in crypto. You're going to move it around pretty quickly. You're going to use bridges. You're going to use mixers. You're going to swap it in and out of different currencies. Anything you can do to start breaking the chain. And ultimately, what we're trying to do at Elliptic is make sure that despite those efforts to obfuscate the trail, that we can still follow those funds. And so, we have data and intelligence teams that are currently working in shifts, so they're working 24 hours because the North Koreans work in shifts and don't stop. So it's about making sure that we can see what's happening in real time and get that information to our customers, so that if there is an attempt to off-ramp through one of our customers, that they get that information early enough to be able to block the transaction, seize the funds.
That's fascinating. So at this point, you can actually see where a lot of these funds are on chain, right? And so what do you work with exchanges like Kraken and Coinbase and all the rest to alert us that anything having to do with these particular addresses or smart contracts we should be aware of and sequester funds when we get them and that sort of thing?
Yeah, exactly. A really good example of that is the weekend that it happened. One venue in particular was being used by the North Koreans to start moving funds and exchanging the ETH for other assets, and that was EXCH or EXCH. And something we did to support our customers was make sure that that particular entity was flagged as very high risk entity, so that if Kraken were to receive some kind of deposit attempt from them, you would be firing off risk score alerts at 10, the highest risk score, and that would trigger your processes that would then automatically block the transaction from taking place.
Interesting. So presumably, look, this hacking risk exists because, I mean, maybe I can test this with you guys, but it seems like what's at the bottom of all these risks is that these things are bearer assets, right? If there was just some issuer of this thing, you could go to the issuer and say, hey, issuer, cancel these coins or remove them from so-and-so's wallet, move them back to somewhere where we can interdict crime with them. Is that what's going on here? Is this really just like a bearer asset issue?
I think that's one of the biggest distinctions between digital asset custody and traditional asset custody is that these are bearer instruments, and therefore there's a different level of safeguards that are necessary. There's a different level of, like you said, of compensating for issues like this. And we were very intimately involved with Bybit and their leadership team because our clients, use our Clearloop product.
Can you talk a little bit about that? What is the relationship that you have?
Copper's really reason for existing, and kudos to the founding CEO who I replaced 5 months ago for coming up with this idea, but it was really to protect people's initial margin from exchange credit risk and exchange counterparty risk. We actually developed the product before FTX, but I think FTX really underlined what your risks are when you trade on an exchange, that it's not only your open P&L on the trades that you have, but if you post in any initial margin and that initial margin is misused or is hacked or it disappears and the exchange doesn't have the resources to cover that you then lose your money. So we had clients that had pledged $2 billion worth of collateral going into that Friday with open positions to back the open positions they had on the exchange. And our risk team and our sales team acted as an extension, and our ops team acted as an extension for our clients, notifying them that this thing was going on. When it was confirmed by the exchange, we took pretty quick action. We have 2 hourly settlement cycles with Bybit, so our clients started closing down their positions. We have collateral pledged to us from Bybit so that open P&L is protected. And what really allowed, I think, came to a great benefit for the market is that within 2 hours, people were able to observe that Bybit did have the resources to replace the assets that they lost.
So was there ever a point where Bybit wasn't able to cover those losses and they said, hold on, we need to replenish our hot wallets, or we need to draw down on credit lines that we have elsewhere, or was it a smooth and easy?
From our client's perspective, it was relatively smooth and easy. Bybit did a fantastic job. I think Ben and that management team were very transparent, gave the market a lot of color about what's going on, confirmed early that they did have the capital to back that. They didn't have the physical ETH in possession. They got a bridge loan within, I think it was like 7 or 8 hours to actually return assets. What we saw, and what they later explained, is that of the, they saw outflows about 50% of the assets that they were holding. Our clients actually only removed 25% of the assets that were holding on their behalf pledged to Bybit. And I think that the stemming of the run on the bank is what helped protect the entire system from coming down. Because at some point, there is an issue where an exchange can lose their liquidity, right? Like most financial services bankruptcies are not because the companies actually run out of money, it's that they've run out of liquidity to make good on a promise to return money today. They'll have the money in 2 days or 3 days, and that's just too long.
Yeah, you're channeling your inner SBF there
I wanted to
on
add
maturity mismatches. But I mean,
That's Bear Stearns and Lehman Brothers.
100%. Okay, so tell me, how does Figure fit into all of this, Nick? I can see.
I want to just add an echo what you were saying. I mean, the key is in crypto, there is no clearing. There is no central clearing counterpart like you have in TradFi and financial services. That's one. Two, if Bybit did not have the capital, we would not. I think it would be a completely different situation right now. It'd be another FTX very.
It'd be the end of 22.
Yeah. So it's exactly. Yeah. Luckily.
Well, that is what happened, right? In 2022, we saw all of these credit and collateral obligations start to collapse upon each other. We saw the unwinding of all this hidden credit. We didn't see that happen here. And so what I'm trying to understand is that just because Bybit was able to cover these losses, or is the ecosystem different, or like what was like what's the difference?
Backstop the losses with their own capital, and hopefully they'll figure out how to, through their 10% bounty. If anybody knows how to get it, you'll get 10%. And but that's the issue. They had the capital to be able to backstop the losses, and that's why clients were very comfortable.
It's also how the industry responded, though, right? Like everybody saw what happened because Bybit was so transparent about what had happened. Everyone looked at that. It wasn't another FTX. It was, this could have happened to any of us, honestly. So we have to rally for the industry, because otherwise we are going to see a bank run, and that's not what we want. And I do think the industry stepped up to make sure that they were collaborating with Bybit to give them the support that they needed.
Exactly. That's what's so different, that many players pitched in, help with a bridge loan, help to cover their losses, provide the liquidity to not make 2022 again.
Well, and to provide the confidence, because I think a lot of this comes from a lack of confidence. Even if, there's a very big difference between what Ben and the management team did, what we were able to do with them to say that, hey, they made their first margin call, right? The first settlement payments for, it was I think $70 or $80 million came through on our first settlement cycle with them after the hack. So I think being able to publicly say that from independent sources is a lot better than sending around a spreadsheet that has an $8 billion line item for a poorly labeled hidden fiat account. What was it? I forget what it was that Sam sent around.
That's about right.
So I think, it's about instilling confidence, which is what was different here. The two things that instilled confidence: one, they actually did have the capital, so they were actually meeting their obligations. They had 44,000 different redemption or transfer requests to take money out. They were slower than they normally are, but they managed to get all of those, and they had the capital to actually return client assets when they wanted it. And the client assets stopped outflow. They stopped the outflow by actually inspiring that confidence, by being transparent, and by having the money, and by making settlements when they needed to.
The issue that I want to just iron out here is that it was a human error. right? I mean, this is it's not a technical issue. This is like they had the coins were sitting in maybe in one wallet in cold storage. Maybe don't put them all in one wallet, put them in multiple wallets, and then they had to use a middleware to transfer them over to the hot wallets or hot wallet or hot wallets. I'm not sure. I didn't go into deep. Maybe you know more. But I didn't know about the part where it was at the end of the conference and people were tired, and I'm sure it was a human error, and people, the hackers took advantage of this. This is something I'm sure they've been planning it for a long time, and they found the right moment, and they took $1.4 billion worth of ether.
But we claim it wasn't a human error. We claim it was a technology error. Because if they would use a better tech, maybe, that an offline environment can create transaction, no one can do it. A quorum of approval for every transaction, this would not have happened. So it's not only human error, it's also how do you manage your risk? How do you actually, when you're custodying that amount of asset under management, how do you do custody today?
Again, I don't know how the cold storage operates from a multi-signature perspective, but I agree with you. Somebody had to go in and manually do stuff to the wallets and to moving coins around. And they were tired, they were just careless, they didn't care. We've done this so many times. Today is no different than yesterday or the day before. So that's what I'm talking about, the human error.
The human error actually came before that. So because the humans at Bybit actually didn't make a mistake. There were process things that they now would do differently, right? Not holding $1.5 billion in one wallet, splitting it out over multiple wallets. But I think they actually didn't make a mistake because what had actually happened is somebody who worked at Safe made the mistake. This is the software that they were using, made a mistake maybe months ago and allowed Lazarus to insert some malicious code into their software platform.
Human error.
That is human. It is human error. But it will always be human error, right? Like because we don't have robots yet writing all our software code with no human oversight. But I think that is also goes to what the risks are in our space because these are bearer assets is the human error, right? Like we are constantly repelling dust attacks. We are constantly looking at phishing attempts. We have our and I'm not going to get up here and brag because I don't want to make copper a target, but I think every institution that is in this space needs to have a very robust cybersecurity policy, procedures, make sure testing, workflow, and
controls are very important. I mean, that's the key. Who does what, who controls what, whether it's automated or not automated, and that's where human error gets into effect, and it causes a lot of problems.
Yep, and having overprivileged access, if engineers have overprivileged access, right, like which is again what our CISO thinks happened at Safe that allowed software code to get pushed that was incorrect and was Lazarus
probably not tested.
And so I think there's a lot of stuff that goes behind the scenes here, and I think I take your point that this is a market that is a bearer instrument that has no clearinghouse, even for spot trades, much less derivative trades. The Bybit issue was more of a derivative trade issue, or our perspective of it was more of from the derivative side because our clients are trading futures and perps options. But this could happen. This could happen to almost anybody, and so this is why I think it is incumbent not only to do all the right cybersecurity practices, but also think through how you protect your assets and who you're trading with matters as much as what are you trading, because counterparty risk is very much a part of this market, and I think that we need to come up as an industry with the right solutions. And I'm like, probably the oldest person on the stage and the most TradFi person on the stage, and I think
I'll challenge you with that there.
and I think that as much as we like the decentralization and there's an ethos of what blockchain and what crypto can do for industry, I think we also need to recognize that there are a lot of practices that traditional financial institutions have implemented that really do go towards this safety and soundness of the financial system, and we have to somehow meld those two together. And so I like what you're saying about clearing and about ATSs.
And clearing is very important, not because I worked on Wall Street for 30 years, but I think it's another mitigating.
Now you're just trying to show me up about how old
No,
you
no,
are.
no, 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 not yet.
I've also done 30 years.
I'm getting there. But like on our exchange, we're not a custodian, we do self-custody. So the assets are not commingled, and we do perfection. Whenever there is a transaction executed on our club between a buyer and seller, we perfect the securities and then we move them over. So the chance of hacking the exchange it's not going to happen because everybody owns their own MPC wallet. They have the multi-signature, the multi-approval process within every wallet, which is very important. Now, it doesn't mean we don't believe in custody, but there is room for everything, and everybody does it. With crypto, a lot of the exchanges, like Bybit, they want to do custody, they want to do hot wallets, they want to do cold wallets, they want to do all these things. And when you commingle so many processes under one roof, you're vulnerable for mistakes and for issues. And that's what happened. So.
Go ahead.
We kind of challenge the security of an MPC. What we're saying is human error would always happen, and the only way to protect yourself is really to eliminate any potential attack vectors. And that's why a little bit about how we're doing it today is basically we develop an impenetrable vault. What we're saying is show us any solutions in the market that claims they have a cold wallet, and we will show you the attack vectors that exist in that wallet, because blockchain is interactive protocol. Every time you create a blockchain transaction, you need to receive the most updated UTXO, the most updated nonce. That's exactly the point where your wallet becomes hot. We actually have a pattern of generating everything internally, only output signed transactions out. That's how we managed to get the 1 billion. But what we're saying is that's the only way to really protect the assets, because you don't know which human error exists. You don't know which will be the next attack. And the way to do it is really having the ability to do it completely offline while never receiving any digital input, and of course had the robust compliance and policy above it. Of course, in combination with an MPC, you have to have it usable. So a combination of both, I think it's the best approach to actually manage risk, but also manage your operations.
I think it's a little bit scary, though, to suggest that we can completely protect ourselves. Like we shouldn't ever accept that that's the case. Like that should always be the goal, but what you always have to focus on is protect, but then assume we're going to get attacked and make sure we have a plan, that we know what we're going to do when we get attacked. And that's something that Bybit did do really well, right? They put that plan into motion, and that's what enabled them to inspire confidence, and the market didn't respond in a really negative way.
The question I have is, are there other exchanges that have similar vulnerabilities as Bybit and don't have the capital to backstop the hack? That's going to be the issue.
Yeah, whether it's
how do we identify this? Right?
I mean, we can hypothesize many scenarios where the industry will be like really strongly at risk, right? This started with social engineering. Every single company in this room that we work with is exposed to social engineering attack, right? We could imagine that a stablecoin issuer suffers some kind of insider threat like that, and someone gets hold of the private keys and starts, creating more whatever stablecoin, right? Imagine like what scenario that puts us in. I think this, to your point, Amar, we have to look at TradFi. We're kind of going through that maturity cycle now. Like this is cyber risk that we're dealing with, and we have to take really seriously. The kind of traditional kind of phrase of trust but verify, like right now in crypto, it's not trust but verify. It's like don't trust and be really paranoid. I think that's where we're at. And I think, every single element of the workflow, the process flow, whether it's humans or whether it's technology, we should be, double checking, triple checking every element of that.
I want to just on your stablecoin point, not to try to oversell our new stablecoin, which is the first SEC-regulated stablecoin. You can't do what you said with our stablecoin, because it has to be issued by Figure certificate company. Every holder has to be accounted for, KYC, AML, and has to go through our transfer agency. So maybe everybody should just.
Well, that was just a layup. Just
thank you. Maybe everybody should use our yields product, YLDS. Thank you.
So if your coin gets hacked, what happens? You just tell the exchange that has it or the wallet that has it? You don't even tell them. What do you? Can you just
Well,
delete it?
If it gets
Return
hacked,
it?
If it gets hacked, like if you steal, so our stable coin is based off a certificate. If anybody knows what certificates are, it's similar to insurance companies were set up as certificates a long time ago, and we can invest in all fixed income securities. So every certificate that we issue have to have a unique holder, right? And now the beauty of certificates is they're peer-to-peer transfers. Unlike CDs or mutual funds or money market funds or bonds or equities, you can't transfer them peer-to-peer. But when you do the peer-to-peer transfer, the certificate issuer, Figure certificate company, needs to be notified immediately that I took my one unit of yield and I transferred it to you. So now you become the rightful holder of this. So if anybody steals if anybody hacks my one unit of yield and takes it, it doesn't matter, because at the end of the day, that one yield is still documented as mine, and I continue to earn the interest on it on a monthly basis. So I can go back to the Figure certificate company and say, hey, my 1 unit of yield, here it is on the blockchain, was hacked or was stolen, and we can reissue another one.
But it's not the bearer of the token that receives the interest. It's whoever is the owner on the books and records of the.
Correct.
Interesting. Okay, but presumably, if I'm the owner, or if I'm just some reporting, or I'm just some enforcement agency somewhere out in the world, I can say these coins were stolen. I can appeal to you as the issuer of the coins, and you can unwind a transaction. You can rewrite a transaction. You can delete them.
We could, we could, but we need to understand whether was it really hacked, was it stolen?
Yeah, presumably you have some process for
Correct.
vetting these requests,
Yes.
right? But if the coins were to end up at an address that's been sanctioned by OFAC, right? That's one of those sort of patent violations that you would say, well, we're not going to permit that. We're going to delete these coins or just prohibit them from being transferred there.
We issue them for you.
Yeah.
That's right. Because they're yours. We have it on record. We are also the digital transfer agent. So it's like you own an investment in a private fund, and you can't lose that investment, because you are the holder of record of that specific investment. If you lost the bearer bond or somebody stole it, it means nothing. You can still, it's yours.
So it's less a bearer instrument, right? It's not a bearer instrument, is because there's a centralized books and records that keeps track of who's the owner of what, which.
Correct.
Right? Which, again, there are parts of TradFi, there are parts of DeFi that come into play there. You know, for us, and I definitely do not want to be the guy that's been in a job for 5 months and then says something that is going to get me fired. But, you know, I think what we're trying to do is bring the aspects of DeFi that are capital efficiency, operational efficiency into the TradFi space. So not going to get into the debate about should we decentralize and are banks evil, but like, can we get into the debate of why are we moving collateral T+1? Why do we take risk to each other when we transact in the traditional financial system, tying up a bunch of capital, right? The amount of capital that you have to have at DTCC or you have to have to some clearinghouse, because margin is not going to move, is only going to move once a day and is going to move with a T+1 lag. And so what we've seen in crypto is that we've solved that problem to some degree, being able to move things on an hourly basis. And maybe the right answer is some hybrid where we're moving things on an hourly basis, but when those things get stolen from you, you can actually reverse those transactions, right? And that's, I think, what maybe is the sweet spot we're going for. In the interim, we're in a spot where you got to play both parts of defense, right? Like, let's move things hourly to solve the credit risk problem, but let's also allow the freedom of movement without a centralized database. And so therefore you have to have all the protections you would need for a bearer instrument.
So it sounds like we have 3 different perspectives on what happened here, right? There's a human error, there's a failure in people, there's a failure of the tools that were being used to secure this wallet. But it sounds like what we're really spending time on is a market structure failure. Like, it sounds like a big component of what happened here, and if you generalize it across what can happen next time, which I do want to talk about, but if we generalize that across the kinds of risks that exchanges and custodians and all these centralized points of failure, all the kinds of risks that we all run, it sounds like what you're advocating for is a change in market structure where we move backwards to TradFi market structures to solve some of the risks in DeFi.
I think I wouldn't say move backwards, but
Well, you can be a little pejorative. It's okay. You can say.
Turn and
but well, look, I would be the first to be pejorative. I left TradFi to come to this. I think it's more of the add the technology, bring the processes, workflows, and some of the protections that TradFi has through sensible regulation, right? There's a reason why American capital markets are the #1 capital markets in the world. It's because investors, companies, all believe that U.S. equity markets work, that it's an efficient way of forming. It might not be as efficient as possible, but is the most efficient in the world. It's the usual statement, right? Democracy is the worst form of government except for all the others. I think American capital markets are the worst form of capital efficiency except for all the others, right? And so I think bringing that aspect to the technology of blockchain is important. And I think self-custody is one option, as you're saying, but there are plenty of market participants that don't want the burden of self-custody.
And can't.
And legally
Also
can't.
can't.
I mean,
And I was going to say, and have the regulatory requirement that they don't self-custody. And so you need to accommodate all of these things. I know that there's a lot of review about is crypto different and could that be custody different, but I think we're getting to a place where we're going to blur the line between what is crypto and what is not crypto, because a tokenized deposit, if that becomes a thing, depending on what happens with legislation, is that crypto? Because that's a dollar that moves on blockchain rails. I mean, right? And so we're going to have to now start to think about, okay, what is the true way of creating a safe financial system that uses good technology, but also uses good practices and regulation?
Well, let's pressure test that. Should exchanges and should infrastructure providers today, we'll stick with exchanges for now, should exchanges be doing custody? Should we be doing our own clearing? Should we be doing our own custody? Or should we just be like EDX? And should we just do trade execution?
I don't think so. I don't think exchanges should be custodians. Not because we're not physically a custodian, but I've never seen the value of that. I mean, I understand why a lot of the exchanges today are also custodians, because it's just a nature of the beast, and this is where we are. But ultimately, exchanges should not be custodians.
Sorry, go ahead. What do the rest of you think?
I think the answer is a little more nuanced. I agree that the exchange should not be a custodian, but in traditional finance, there are exchange groups that have a matching engine where the exchange of shares or futures or something happens, and then they own a clearinghouse, and that is a custody type business, right, where they're holding the actual assets. So I think that you can have both. It's nice to bifurcate them, because then you can ring fence your risk and you can run capital appropriate for each entity.
Those exchanges are not the clear. They have a central clearing counterparty. That they might
Agreed.
be the
No,
owners.
that's what I'm saying.
Yeah.
That's what I'm. So I agree with you.
Clarify for everybody.
I agree with you that the exchange entity should not be custodian. It would be cleaner, because then you can have the right capital requirements and the right regulatory treatment for different types of businesses, as opposed to trying to find one regime that's going to fit a melding of 4 different types of businesses, right? Like a broker-dealer, a custodian, an exchange, all wrapped up into one.
I can't remember who said it yesterday, whether it was Belshi or Nathan, Mike Belshi from Bitco, or Nathan from Anchorage. Finally, one of them said it. Maybe they both said it. I don't know, but they finally agreed that custody fees are going to 0, so it doesn't matter anymore.
You'll notice that I didn't say that we're a custodian. We're a collateral manager that provides custody, which I totally agree.
Yeah. So at the end of the day, the exchanges are not going to have any incentive to provide custody, but they are making a lot of money on the back end of the exchange fees and the execution fees. and maybe financing and leverage. But you need to take that business out of them. Whether you create a central custodial platform where all the exchanges can clear, which is basically what you do. I mean, your network. I mean, that's but
We're on that evolution there. I think the biggest risk I see is actually not the hacking risk, because I mean, while those events are big and the last one was big, those tend to be less frequent. I think the bigger issues are, what are the lending standards? Because these parties, these centralized parties, also use their balance sheets to lend, and you need to understand what is because you're effectively taking the credit risk of your counterparty, and if your counterparty is making bad decisions on lending and bad underwriting,
that's your hypothecation.
there's your systemic risk right there.
That's
So-
your hypothecation, and we have to worry about that.
I definitely agree. The crypto exchange should not be the custodian, although some of them really want to be the custodians. And I think that some regulations even trying to push it. So, for example, in Turkey, crypto exchange, well, the new regulation says that crypto exchange cannot be the custodians anymore. And they're allowing the banks to actually be the custodians, and they tell the crypto exchanges, you want to do custody, you have to work with one of the banks as your custodians. Well, you want that liquidity. So there are some regulations who push for that, but we don't see it globally. We usually don't see the regulator says crypto exchange cannot be the custodians anymore. For example, us in Galaxy, we're not a custodian.
Would segregating custody and trade execution have prevented the Bybit hack?
No,
No.
No.
no, it would not.
I don't think so. In fact, I'm struggling, frankly, to follow the reasoning of why an exchange should segregate custody at all. I see why margin and collateral management is an important function. I don't know why segregation drives that outcome.
I think it's because, so you can have, Bybit happened to be in a position where they did have the appropriate amount of reserves for what they custodied. And I think that not every exchange.
Was anybody kind of shocked by that? They just peeled off 1.2. They just like pulled 1.2 billion out of their pockets and just like 1.4, whatever it was.
Didn't we
Just
see another?
peeled it off the wad. They're
Didn't
just-
we see another exchange pay $4 billion in fines?
Yeah.
That's true.
So I think
guess
we know
this
that
is
they're
crypto,
profitable.
right?
We know that they're profitable.
Yeah.
Right?
Yeah.
We see Coinbase's 10K, so we know that they're profitable. So you're not surprised.
I think they made like $2.5 billion last year, so or they make, I don't know. I read somewhere where it's like $2.5 billion either every quarter or every 6 months. So to them, 1.4 billion. They've had that money for a long time. They can.
Well, it sounds like, representing an exchange aside, it sounds like the exchanges kind of have this issue covered. Like, why does segregation help us here?
Well, maybe Kraken had it covered and Bybit had it covered. Do we know that every exchange has it covered? Because the regulations that govern exchanges don't necessarily require the kind of capital that would govern.
No, they don't. They
should
have
definitely not assume
in no jurisdiction is there such a requirement. Okay, so we only have a couple of minutes left, I think. The 2 minutes left. What's the next hack? What should we be worried about?
It will probably be, not saying that's the next hack, but it would for sure would involve deep fake, social engineering. All the AI tools are scary when it comes to the hacking event that we will see, because those are new. We haven't encountered them yet, and those will be a super sophisticated and scary ones as well.
So impersonation is the class of risks that you're foreseeing. What else should we be looking out for? You've got an ex-executive of Kraken. I still have a couple of friends there. Tell me, what should we be worried about?
Well, I think it's not just Kraken and the exchanges. I think everybody should be worried about. It's social engineering, right? Like the weakest link in cybersecurity are the people that are involved, and so it's constant training. It is constantly testing your defense policies, procedures, workflows. It sounds so boring and bureaucratic, and I can't believe I'm saying that. As a former trader, I can't believe that I'm now talking about things that are compliance, but I really think that is where this comes out. That is what is going to protect institutions like ours and our clients from hacks. I think the actual bigger risk than a hack is the amount of leverage that's in the system that we don't know about because it goes unreported, and a big market move and the auto liquidations that might happen could really drive a death spiral in some of these institutions that don't realize how levered they are because they think that they have enough capital to withstand that market.
Yeah, so we have impersonation, we have 2022 all over again. Any last ones?
I mean, you know, regulation is important, not because I'm in favor of regulation, but regulation forces the counterparties to be diligent to do everything you said.
Sensible regulation.
Recheck your policies, recheck your risk parameters, constantly look under the hood, constantly do penetration testing. Don't release anything unless it's fully tested. You know, it's the tech model where, you know, just release it, we'll worry about it later. Or, you know what, release it, let the users figure out whether it works or doesn't work. That doesn't work. That's a problem. So
I think we're moving to a place where, yeah, code, code is law is not quite working for the big institutions. Law is law. Code needs to follow law. And we're started making that migration. So I agree with you. Like, but we just need sensible law and not specific law for crypto
Correct.
that is different or like
it's
off.
true.
This panel could never be confused with anything from ETH Denver.
No.
Just nothing. The law is law here in New York. In Denver is where we have code is law. Listen, you guys, thank you so much for joining us today. Please give our panelists a round of applause. I thought they were fantastic. And thank you.